Which of these fancy devices would you like?
What is their preference on
No, not really. They're both fine. Sometimes this guy gets a little staticky if you're touching your shirt too much. Okay, I was gonna say it's for the people online. I know most people don't hear you, but the people online will be like, "Get here." Oh, this one for Ryan then.
perfect?
And if you just want to join this Zoom link whenever, and I'll make you a co-host whenever you get it. Okay. It's on for you.
Which Zoom do I click on? If I go to like the team meeting one, will it work?
Calendar up by chance. Here he can. Maybe you're easiest way to get out there. Okay, there you go. Yeah, just that should bring it up. Yeah. Oh yeah, okay, see it. Yes, and then I'll just add you as the host. You do it. You can share your screen. Yeah, that should be it. Yeah, for trainings we use a different one. I don't know why. Yeah.
Okay. Anybody else feel like it's spring outside?
I was thinking the same thing when I got in my truck today.
My dogs are like crazy because I think they think it's spring and they've gone really mad.
I feel like somehow we're going to get a payback.
Oh, for sure.
Really sad to think that it's not made. Like this is like you get like walk another.
Yeah. Yeah. And I'm puppy sitting with a 1.5-year-old dog, but and she is like all I am. She's like, let's go. So I was like, okay, this afternoon I owe them like a long walk because yesterday they were just there. I was like, they know it's coming. Their energy just shifted. It'd be interesting to see how like hometown traffic is this weekend compared to the last couple when it's been cold. I add stuff to yours, but it's just like a little, not anything really. Just a little something. Should I be letting people in or are you? Hi, Claire.
Hi.
Claire's here to say, don't do anything. To give out warning?
Oh, my presence doesn't mean something nice.
I'm not saying that. It's positive.
Okay, good.
I mean, one of my first disclaimers on here is I am not an attorney today, and we are not attorneys.
We've had a conversation.
Yeah. Oh, I just put in,
Thanks.
I put in at the beginning. What is assumable mortgage, and then I added in like how would you the seller can offer? So I'm trying to talk to them as agents, which we be
Sure.
focused on. So how would I know if a seller can offer or should potentially offer an assumable mortgage as part of the marketing package? And I'll kind of be like ask these questions. And then on the buy side, how would a buyer know if this assumable mortgage like an option for them?
Okay.
Where do we look for? I mean, I can try that.
You know this.
MLS, yeah. We have to know if they're offering it. Potentially, if a buyer could look back and just like you could search first. We're an FHA or VA. We've got a story that like she could there. And then I just broke out what are the pros and then
So you spread, okay, so it's spread out.
Yeah.
You can put it however you want it, like deliberate.
That's what I thought. Oh, I know we're so crazy. Oh my God.
The meat and potatoes of this is really the seal.
all my things. My drink. Stuff. Give it to like 11:03 and let her rip. that made me laugh.
It's just the look.
Just blank face waving back the room. Hi.
All right, should we get going? Okay. All right.
Is this on? Yep.
So I see a couple faces in the room that came to the class when we did this during the team meeting that was on contract for deeds. You're going to be sad because this is going to be virtually the same conversation. We are adding a little bit of assumable loan, so feel free to not participate or to participate more because I know that both of you were here, you know that. You contributed a lot the last time, so feel free to contribute a lot with
Here.
Ryan was here also.
Yes.
So to start, I'll introduce myself quickly. My name is Annalie Nienow. I've been a real estate agent since 2004. I've worked in the industry since 2001. And why am I qualified to be teaching about contract for deeds today? I've done a handful and I got nominated. When the interest rates started climbing, in about 2 weeks, I had, I think, 8 to 10 calls saying, how do I do a contract for deed? What's going on with contract for deeds? We're going to have to use contract for deeds or we're never going to do a deal again. I think people were starting to feel that when we were reaching the 8s in interest rates. I felt that pressure. I was sharing with Ryan yesterday. I felt that pressure release a little bit. This conversation has died down a titch with interest rates coming back down into more normal historical range. And I think it's still a tool that we should be aware of and we should know when it might be a good tool to use and when it might not be. We're adding to that original class that was about contract for deeds. And we're going to talk a little bit about assumable mortgages. And I'm saying a very little bit because there's not that much to say. Ryan is here to kind of give some insights from a lender perspective on those and how we even know when that's applicable or when it could be a potential. Another tool for the tool belt, right, to understand. And more than anything, I think that both of these conversations are going to be to help us as agents, again, bring those tools to our clients, or if our clients bring them up to us, not say, ooh, I don't know anything about that, right, but kind of have the baseline. I would call this a 101 class. This is not going to get into the nitty-gritty, deep, dark details about walking you through how to write a contract for deed, financing, addendum. We're not going to go into the specifics of how to go through an assumable mortgage. We're really doing the basic information. Fair? All right, introduce yourself.
Ryan Molstad, loan officer with Team Taylor for Fine Lending, Lumen Home Loans. Doing mortgages for 13 years, have an office in here. I'm sure I've seen most of you around before. Yeah, I'm like, as Annalie said, I'm here to give you the perspective from the lender. Typically, we're not dealing with either of these items me directly often, but I know enough, obviously, because you're dealing with financing and we do handle, I've handled many contract for deeds on the refinance side after the fact, so I can help in that perspective. And then obviously qualifying for an assumable loan, you basically are trying to qualify for your standard mortgage, so I can help in that regard as well.
All right. So we're going to get right into it. We're going to start. If I can make my computer work here. With a little disclaimer and reminder. First disclaimer is we are not attorneys. We're real estate agent. Well, I'm a real estate agent. He's a lender.
Got it?
We are not giving legal advice today, right? And we are not going to talk about the legalities in a deep way. Oh, yes.
Sharing can you share your action screen? It's on the slide page, sorry. Oh, yeah.
Wait, I'm sorry. What's happening?
There's a slide page that you click to go that.
That's when I hit slideshow. Here, let me try that one more time. No? Still doing it? Yeah, but if I go to slideshow, right? Sorry, guys, I don't know why, oh.
Difficulties, sorry.
Is it showing?
Showing the like side page.
Showing that instead of,
Um,
I don't know what you mean by that. Oh, swap display.
yeah, that might,
Oh, there.
there we go. Perfect.
Yeah.
Woo.
Okay,
Okay, back to disclaiming
that we're not attorneys.
Um,
The other thing that I want to say is that our job as a real estate agent is not to be an attorney, right? And so again, we're not going to talk them through the legalities of what a contract for deed is. What we are going to do is offer information to our clients about the pros and cons, risks and rewards of doing a contract for deed or an assumable mortgage and see if it's a good fit for them. And be prepared that an attorney can and maybe should, we'll ask Claire for her opinion on that, our broker, be involved in a contract for deed. They do not have to be legally, and it never hurts when you're getting into these riskier types of situations to have an attorney's opinion involved. Especially if your client is at all confused or is at all nervous about what they're actually getting into. We'll get into that a little bit more. Claire, do you have any thoughts on if an attorney should be involved in a contract for deed?
100%. I feel like unless you're doing something between family members, which is the only time I really I mean, it's risky. We'll get into all of that.
Yeah,
We'll talk more about risks.
I think so many times our clients really view us as the experts in everything and want us to answer everything, and they don't want to pay an attorney because we're giving them advice for free. And I think that that's dangerous because I think that, you know, this isn't a type of transaction that we're very familiar with in our business on a day-to-day basis. And there are a lot of risks potentially. And I would, as a real estate agent, want to remove myself from those risks as much as I can. Because when something goes wrong, they will blame us. That's why I would always recommend having an attorney.
Yeah,
Question.
How much is a real estate attorney nowadays? About $500, something like that?
Completely. The question was, how much does a real estate attorney cost? It completely depends. They're gonna charge different amounts based on who they are. They're also gonna, some of them charge hourly, some of them will do a free initial phone call to kind of talk through some certain things. So it all depends on their business structure. I would guess at least a couple of $1,000s to get through this. Most attorneys, the bills rack up very quickly, which is why people are not gonna want to talk to them necessarily. So. Okay, disclaimers done. Now we can just get into the nitty gritty. So we're gonna start with assumable mortgages. Ryan, what's an assumable mortgage?
Basically, it's a loan that you as a buyer, you can take over those contract terms. That's as simple as it gets, right? So you're basically transferring whatever the terms are on that current mortgage to another person. They're assuming it under the same terms. So that's going to be any government loan. So FHA, VA, and USDA. Technically, a conventional loan could be assumed, but it's in rare instances. As far as, why you would want to do one, Obviously, right now would be one of the prime over the last year would be a prime example with rates being as high as they've been. A lot of the mortgages that someone has over the last several years is probably at a much better interest rate, and than what it's been over the last 12 months. So being able to get in on a much lower interest rate, having a much lower payment would be one of the biggest reasons why people would want to do that. There's also other benefits in terms of it potentially could have less closing costs, potentially not have to get appraisal. There are different benefits there. The downside is always going to be, though, that potentially you would have to come up with the difference, or you would have to come up with the difference of what the new purchase price is and what the balance is currently owed on their mortgage, and that could be sizable depending on how much equity position they have. But I think we're going to get into kind of the more of the pros and cons here. So,
Yeah, so an assumable mortgage is the buyer taking over whatever mortgage the seller has if it is eligible to be taken over. It's simplest form. Make sense? Questions about that? Yes.
So just hypothetical numbers, a home is purchased for 300,000. It has, from the current seller, has $150,000 mortgage on it. The buyer may assume that $150,000 mortgage and then needs to come up with another mortgage or some portion thereof, or down payment, for the other 150. Right. And so obviously the result of that is that for roughly half of their loan, or a little bit more than half of their overall mortgages, they're getting a better interest rate on that portion. Okay.
we're going to get in a little bit more detail on some of that here.
So let's start with talking about how. So if I am talking to a seller, the real estate agent, and they said, oh, I've heard about these assumable mortgages. How do I know if I can do that? Would that be a smart part of my marketing package, right? Is that something that's going to help bring buyers in if I'm offering that? How would a seller know if they could even do that?
First, the type of mortgage that you have in the first place. So like I said, any government loan. So if you know that your mortgage is FHA, VA, or USDA, it should be assumable. I say should, because at the end of the day, the lender still has to approve it. So there are some different dates. I won't get into all those. There are some different dates depending on when the loan was originated, they may or may not have to actually approve that assumption. So if you're a seller and you want to know, is this something that I should be looking into? You want to reach out to your current loan servicer, the company, and you would want to ask them, hey, would I be able to do this loan as an assumable mortgage for a buyer? And let them tell you.
So just reiterate, you would want to reach out to the current loan servicer. So not your loan officer that you got the mortgage through when you purchased as the seller, but the current processor of or servicer of the mortgage.
Yeah, you definitely want to get the green light from them first. There can be some issues that you could run into with some servicing companies that if the buyer is having to bring a second mortgage to the table, there could be some issues with that. They don't always like that. So have those conversations because you don't want to be putting out there that your loan is assumable and then you've got a buyer and now you can't actually do the deal.
I've noted on that also, it's all gonna be about risk mitigation for that first lender, right? So in your scenario, we're talking about a $300,000 purchase price. They have a current mortgage of 150, and you're looking to get a second mortgage for 150 or close to it. Who's got first and second right? If something were to go wrong, that's going to be a higher risk for that lender. Now, if you're bringing 150 cash to the table and you're not trying to get a second, that's a different situation. And so the lender is going to want to know those details as well before they're going to be able to approve. So make sure that you're not just blanketly ever stating this is a mortgage, an assumable mortgage. It might not be depending on the terms that are being presented to that first lien holder, which would be the first mortgage company. Is that tracking? Okay. For a buyer, how would a buyer know if there's an assumable mortgage option? Usually it's just in the MLS, right? If you were really, if a buyer was really tight and you know, they had a large down payment, but for some reason it only works if they can get a lower interest rate or something like that. Maybe that buyer shouldn't be buying right now, in my opinion. Like, let's not go crazy. You could check on the property and see, oh, they love this property. Let's see if an assumable option is even a potential. And look and see if it was a government loan when they purchased it. So you could go back and look at what the terms were at the time of closing. But typically, it's going to be offered as part of the marketing, and there should be notes just in the listing that the listing agent has put out. Or type of financing, there's the term, right, or the box right in that MLS that talks about, is this an assumable mortgage? 99.9% of them are not going to put that in there, or not going to go through the rigmarole, but I am seeing it pop up a little bit more here and there, so.
So you're saying it wouldn't be very effective to just go look for where it says assume, because that's gonna be 1% of the agents actually put it in. So.
Well, does the seller want to go through contacting their company and going through those extra steps? Is it gonna, and I would say, some of that is gonna be, is it worth it? Is that extra time and energy worth it to my seller to get a bigger buyer pool or get those potential buyers out there that are specifically looking for a assumable option? In today's world, as a listing agent, I would say probably not. If things got, again, if interest rates jump back towards 10% all of a sudden, and people are struggling to be able to, with affordability or to be able to move forward with purchasing, does that change the conversation? Yeah. Now I might be looking at sellers with an FHA mortgage and saying, let's absolutely look into this and see if it's an option, because this is going to be more important than in that world than it is now. Make sense? All right, I guess. Yeah.
Just tell me if this is like too far off of a tangent, but from a finance perspective, why don't conventional mortgage companies that have conventional loans, why don't they make them assumable? Seems like they would want to keep their pool of loans ever increasing.
Good question. Good question. Why? I don't know why that would be the case. I don't know. I'm sure there's reasons for it that are all financially based, but
Again, so I heard before that the VAs were assumable, but I hadn't heard that the FHA and the USDAs were assumable.
Yep.
And it's like, not just for some time period, but you know, maybe a loan given out 3 years ago would be assumable.
yes. Yeah, they've been assumable ever since at least I've been in the mortgage industry, so. Yeah.
And so there's probably a data source where you in particular, and you generally can find these loans, right?
Yeah, I know one trick people have used is going through your title company.
The other thing is you can just go through stored data. So if you have a buyer looking in a certain area, you want to look for all homes that might be an option with an assumable mortgage. You can just go through and see what their financing terms were at the time of closing, and that's all in the MLS. It's going to be some legwork, but you could definitely do that. Now, the next step is, do any of those people want to sell? They're not active on the market. So it's a lot of legwork to try to find. And again, right now, for what? For a potential saving of 2%? Is that all going to be worth it? And is it ever going to pan out? Maybe that would be your choice and what your buyer is looking for and what they really need, right? Yeah, question.
If it's an assumable VA loan, then whoever is assuming it would also have to have a VA loan. Is that the same then for FHA and USDA?
So, VA loans can be assumed by veterans and non-veterans, actually. So the issue that comes with that, if it's a non-veteran assuming a VA loan, is the seller, who's the veteran, their entitlement then gets tied up with that property. So if they're trying to buy another property using their VA benefit, they won't be able to, or they'll be very, very limited, one or the other. And so typically you're going to want, if you're a veteran that has a VA loan, to have another veteran assume it using their entitlement. But technically it could be a non-veteran. Like you would probably only get that in like certain family situations, something like that. Something, yeah. But yeah, typically the veteran doesn't want to tie up their entitlement on someone else's now property. And then as far as the FHA question, they just have to qualify for FHA mortgage is all.
Okay, so what are some pros to assuming a mortgage?
Kind of went over it a little bit, I guess, already, but obviously right now in the market where it's at, having a lower interest rate potentially, anyone that bought a house and has a rate that's in the 2s or 3s compared to where they've been 6, 7, 8, that's a huge difference. Again, like I said, you might not actually have to apply for the mortgage. There are some lenders that'll be a little bit more lenient on these, but typically you're gonna have to go through the same type of qualification application process. If the seller, like if they purchased it more recently and they didn't put a lot of money down to begin with, then that gap that you're having to fill isn't as big. Potentially, you might actually not have to come out of pocket for as much as you would on a standard purchase, right? So because you already have that loan covering majority of it. So those would be I think the biggest pros at this point. We have the cons next.
Yeah, tell us about some cons.
So the biggest one is definitely the fact that, you know, if they have some equity and in that home has appreciated and they paid down their mortgage and there's a big gap between the new sales price and the purchase price and what they owe, then yes, you're gonna have to come to the table with a lot more money. If you don't have that kind of cash lying around, that means you're probably gonna have to finance it using more than likely a second mortgage. And those rates are gonna be a lot higher, right? So those are gonna be, you know, probably 8 to 10%, somewhere in there these days, because of where prime is at. So that's gonna be kind of almost offsetting in some ways, of the fact that you're getting, you know, the really low mortgage on the bulk of it. Like we said, the actual servicing lender might not cooperate, especially if there is going to be a second mortgage involved. So you do have to get everything greenlit and approved by them, which that can be a little bit more of a process. You're gonna have 2 mortgage payments. If you're not coming to the closing table with cash, you're gonna have 2 mortgages. So you're gonna have 2 payments. That can get a little bit trickier for people. Some of those, depending on how that second loan is structured, you might actually have a higher payment ultimately, right? Even with a really low interest rate on the first mortgage. So you just got to run those numbers and see if it makes sense. And then for the seller, if that liability is not released, it can impact you. So technically then it could be someone else making those payments. So if they don't make a payment on time, it can impact your credit. So until that is released. So especially if it's a VA loan and it's a non-veteran. Yeah.
They released a liability.
The lender will release it and then you'll go through the title company.
So that doesn't happen all the time. It happens sometimes. We don't.
Again, it's
It's the
everything is-
servicers,
yes.
it's their discretion.
yes.
If they're gonna fully release the first owner or not, because it was their loan originally that they.
Yeah, the problem with these, it's so situational and case by case. So that could be how they,
Still be liable for
more
whatever.
than likely they'll release it. But there are instances where it's not.
Important to know. If it is or not.
Leon, can you get that answer?
How early on?
Yeah.
Well,
Just like Nick, you know, like, can you find it early on to look for alternative financing?
I don't know. They're gonna tell you that right away without knowing specifics of who's gonna be assuming it. You know?
Well, only some mortgage companies offer that second mortgage, or is that a product that is relatively?
The second,
Easy to get.
you can get that in. I think it's probably easier if you get it through the company that has the first. I think you have a better shot of them actually going with the overall package that way. But technically you could get that.
What percentages are you looking at? Think of, did we go up?
What part?
Yeah, like the second mortgage, 20, 30, 40.
What like loan to value?
Yeah.
Oh, that's gonna vary by lender, how high they're gonna go. You're saying like, usually they'll do like, like they'll go up to 80% on the first, then they'll add an additional, depending on the company, they might be able to go up to 95%.
There might be some point in the future where we get to the 5 to 10 year mark on those who've purchased homes at the 2 and 3% rate, where they get to that 5 to 10 year mark and they're looking to sell, depending on where current mortgage rates are at that time. That spread could be significant enough that we might see assumable.
I think that they will work when the market demands that they be a part of the conversation. If the buyer pool is demanding alternative financing options because the rates are so different or so high, it's not even about the spread necessarily. It's more about where are they and what's affordability doing to the buyer pool. So that's a big conversation, but I don't think they're going to become, I don't know. I don't have a crystal ball. I get surprised by real estate every day, but I don't think that they'll become a normal thing unless the buyer pool is so pinched that they're demanding it.
I'm just thinking that we had that, I don't know how much time we had there. Was it like 2 or 3 years where it was at 2 and 3%? And I could see some point in the future where all of a sudden that spread could become more favorable.
Yeah, and I think I saw them more in the MLS. Probably anybody that was working with buyers saw them more when rates were even 8%. Now I'm seeing very few as I'm looking through. I'm not seeing agents putting that out there, but I think that agents were trying to get on the front end of that potentially happening when it was high 7s, 8s, and we didn't know how high they were going to get. There were agents that were saying, like, let's offer this as part of, again, from a selling perspective, part of your marketing package. Let's do everything we can to make you more desirable than Joe down the street, right? Good? Good on Assumable? I know that was 101 basics. Next disclaimer comes in that the last time we talked about contract for deeds, it was a full hour. And of course I went probably over 10 minutes and we've got 29 minutes left. So this is going to be very powerfully fast. Okay. So the first thing is, what is a contract for deed? I think this is the biggest question in real estate that people are like, well, what even is it, right? So contract for deed is a real estate transaction where the seller is the financer. So the seller is the lender, right? The seller is offering the loan to the buyer. So if you can kind of get that in your head, and then what does that mean? Contract for deed is actually, I would call it like a gray area piece of paper or a placeholder paperwork piece. It is written up by the title company or an attorney. It is an actual document. We as agents would facilitate that through contract for deed financing addendum, which I'll show you in a minute here. That tells the title company or the attorney how to write up the contract for deed, or an attorney will just sit down with everybody involved and write up all the terms in a contract for deed. That contract for deed gets filed with the county, and then it sits with the county and says, this is a real transfer of property. However, the deed does not transfer fully until that contract is satisfied, AKA a balloon payment is made, a refinancing is done, a mortgage is put on the property, the seller is paid in full. So it's kind of it is a full transfer of property in the way everyone behaves. However, the title or the deed does not transfer fully until it is satisfied. Does that make sense? That is what I think trips 99% of people up about contract for deeds. Contract for deeds are also called land contracts. That was originally what they were called. And they were originally made, as Claire mentioned earlier, for interfamilial transfers of property. This was often, I think they were originally made for big family farms. Now, the oldest son is getting his portion of the farm and building his house over there on that 10 acres. And now the other son and his wife are going to go over on that 10 acres. That's what they were originally made for. When those family members might not be able to get a mortgage to afford a portion of that family property, that's what this was made for. So they were done with raw land a lot. So when it's harder to get financing on a piece of property, that's kind of why they were made.
might see these big words up behind me. That's why trust in a contract for deed becomes extremely important. Everyone has to kind of trust each other that they're all going to do the right thing moving forward and do what the contract says moving forward. And behind trust, I would put due diligence, that making sure that everybody understands their role and understands the legalities and understands the pros and cons again becomes increasingly important because they are a little bit trust-based. Questions about just what they are? Okay, we're done. No. Yeah. So a note would actually be like a mortgage. That would be the seller offering a mortgage with specific terms. It would be different, in my opinion, for the seller. A note might be a 30-year mortgage. And that is an option. If a seller doesn't have a mortgage on their property, they could offer to carry a mortgage for somebody. But they're offering that for the full term. A contract for deed is meant to be kind of a gap holder. So I'm going to have a 3-year contract. 3 years is actually, I read somewhere, was always the recommended amount of time, 3 to 5. You can do a longer contract for deed, but they are meant to be fulfilled or paid. That transfer is meant to happen. It's meant to be kind of a middle ground, not a full mortgage for 30 years. Make sense?
So the structure of how it's gonna work is completely flexible. I mean, you could create whatever it is that works within that. There's no preset structure to how
There is
a contract for deed.
there's preset structure in that there's a lot of questions that need to be answered regarding those terms, but there is no preset structure as far as what those what the terms the buyer and seller are going to choose are. That makes sense.
Years do you mean to have the loan paid off or to then refinance? There's a lower rate.
To refinance or to complete the contract, which would be paying the balloon payment at the end. However, that's done through a mortgage, through cash, whatever it is. And we'll talk about what those options are a little bit. So fulfilling the contract, which would mean the title then fully transfers over to the buyer. It is a completed sale. The contract is complete or released at that point. Does that make sense? Okay. I'm checking in a lot because I know this gets a little bit convoluted. There's a lot of questions. So again, I'm trying to come at this from a real estate perspective. So I want to know, like, why would my buyer or seller want to use a contract for deed? When does it make sense? How can I talk them through? Does this make sense for you to even consider this as an option right now? So for buyers, why would a buyer want a contract for deed? Open it to the room. Right now, lower interest rates, potentially. Right? That is a term that is negotiable between the buyer and the seller. Okay, so interest rate could be one. Why else?
Qualify for a loan?
Can't qualify for a loan, and that might be credit. It might be they just switched careers completely and they don't have a long enough career history. I had someone after the last class that was the case. She got into real estate actually. She had been in a previous career. It was going to take her 2 to 3 years to have the real estate income to qualify for a mortgage, and so she bought on a contract for deed. Great example of why someone would use them. Why else would a buyer maybe want to use one?
Want to buy land.
Yeah, hard to get financing. You want to buy something that's goofy. Raw land is harder to get financing. Interest rates are typically higher because it's easier to walk away from transaction, more liability for the bank. Mixed use properties, commercial and land, and 3 houses in the back. That's going to be a really odd property to try to get traditional financing on. That's going to have an all traditional interest rate also. Some of those trickier properties are going to start to have more liability, which is going to be higher interest rate. Contract for deed might be a good filler for that. Why else? I'm going to throw logistics in there. I've had people that are selling 3 properties to buy 1. How do we navigate getting this person out of their house and putting them in temporary housing, and right, they're combining families maybe, and they say, oh, well, let's just do this on a contract for 2 years. We'll get all of these things taken care of, and then we'll take all the money, instead of trying to navigate logistics for all those moving parts. Any other ones that you can think of? We'll see what other ones I have. Oh, yeah.
Line question.
Yes.
Do lenders still count the current mortgage as debt to the seller?
So we're gonna get there on if even a seller can offer a contract for deed, because that's gonna be a big question mark. So pause. Logistics, I talked about that. Unable to get a traditional mortgage due to, that could be all kinds of things, like we talked about, credit, all of those things. Interest rate was the other one. Why would a seller use a contract for deed? Why would they be open to it?
The buyer, that's the only option for the buyer that's interested.
Yeah, and in that scenario, I would say buyer pool problems, right? We've got a weaker buyer pool, due to either uniqueness of property, interest rates, right? We're trying to fill a gap. We're trying to add a marketing plus to bring in more buyers or expand our buyer pool.
Thinking also to, not have to pay capital gains taxes right away, all of them anyways.
For capital gains. I'm not gonna touch that one with a 10-foot pole. Talk to an accountant and an attorney if that is your strategy as a seller. I don't wanna talk about that even a little bit.
Do you have any data or statistics that sort of illustrate the expansion of these outside of the familial type of situations? 'Cause typically, from what I understand, that's when a lot of this is used, but going with the, like, is there any, now this percent is tied? Probably not, but I thought I just.
I don't have that data. I think the only way to really try to pull some numbers would be, again, to look at sold, closed data like in the MLS and see if it was reported as a contract for deed financing type. Maybe title companies could pull how many they're doing. They certainly could. A lot of these are non-MLS. And then how to differentiate, was that a familial or an arm's length transaction or not, is virtually impossible. I will say every single one I've done, they weren't all familial, but the people knew each other in some capacity. And so,
Trust point.
yeah. So, to try to differentiate that, I don't know how you would ever figure that out. The one we didn't talk about, why would a seller potentially want to do this? A shorter term investment, right? The property's paid off and they don't need the money to go do something else. They're going to make an interest payment every month or an interest payment. They're getting interest on that money every month. So instead of the money sitting there, they could rent the property out, right? That would be another way to get money in off the property. But this is a way where there's different liability. I'm not going to say less liability than having a renter in the property, different liability, but you're getting that interest every month. So it could be a strategy of making some money off of the property as well, a shorter term investment, if you will. So if I'm sitting down with a seller, I want to talk about, can I offer one, right? One of the first questions that I would ask is, do they have a mortgage on the property? Okay. If they do not have a mortgage currently, it is free and clear. They can do whatever they want. They can offer a contract for deed. If they do have a mortgage on the property, they need to check if there's a due on sale clause in their mortgage. And then I've heard a lot of, and we're not going to spend a lot of time on this because this is a debatable topic, but I've had a lot of people say, well, a due on sale clause says that the mortgager has the right to call the mortgage due at the time of sale, but they don't always do it. Okay. That makes me nervous, right? So I've had investors say, well, yeah, there's a mortgage, but they never call those. They never call that due on sale clause. Well, what if they do, right? Now what happens? How are we going to unravel this? And if you were going to take that risk, I would definitely make sure you had it in writing how you were going to unravel it, probably with an attorney involved to make sure that legally all parties were going to be safe and have an understanding of exactly what that was going to look like should that due on sale clause get called. So I would lean towards no mortgage,
it's an option. If you have a mortgage as a seller, you're starting to get into some gray area unless there's no due on sale clause. And I am not aware of any mortgages that don't have due on sale clause. I have heard that there are some, but I'm not. A traditional mortgage is more than likely going to have one. Do you have any comments on that?
I agree with you.
So once we're through that initial mortgage conversation, does it financially and logistically make sense for that seller to turn into a lender? Right? They're not a landlord. They're not going to have a say on what they do with the property. They're not going to, that person legally has all of the rights to do whatever they want and live in that home. They own it. But are they going to want to be a mortgager or a lender? Some questions that you might want to know about that is, what's the down payment going to be? Does this person have a giant down payment or do they have a really little down payment? What is that monthly payment going to be? What interest rate is the buyer willing to give me? And does that make sense? Or should I just sell this, take that money and go put it into a high interest yield account? You know, sometimes, especially right now, where you can get a high interest yield savings account for 5.1%, you know, if they're at all savvy, they better be getting more than 5.1% for this riskier option. So making sure that, again, sellers, if you're talking to a seller as an agent, you're aware of those things and you're talking them through those things. And then what's the length of the contract going to be? Is it going to be 2 years? Is it going to be 5 years? What are they offering that buyer? How long are they going to keep that buyer? Or how long are they going to stay the lender for that property? Okay. Does that answer online mortgage question? I think I just took care of that, right? Because the question is, if you had that mortgage, yes, they would still have that liability. There would still be a lien holder. Now you've got 2 liens against property. It gets really, or it gets messy. So again, due on sale, make sure you understand that if you're going to go down that path. Yes.
When you find out, if you were looking at this and saying, okay, I could either rent this property or I could do a contract for deed, how would you begin to see which one of those is better for you as a seller?
I think you can go through all kinds of data analysis there, right? What are average monthly rents in your area? How long does it take on average to get somebody into a property in your area? Sometimes it's 1 month, everything is filling immediately. Sometimes they're sitting 3 to 6 months. What does that holding cost look like for you versus having a lender or you being the lender and you're getting that monthly payment? Other difference is you're going to get a down payment when you're on a contract for deed. You're not getting a $25,000 down payment from a renter. So does that down payment allow you to go and purchase your next property or allow you to do something financially that you couldn't do with a renter in the property? Damage on the property, right? You're gonna have turnover with renters. So there's a lot of things that I wouldn't necessarily go through those in a way that I am telling the seller, here's the average rents versus what you might be able to get. You don't know what interest rate you're gonna be able to necessarily get. I would make them aware of these are all the lists of things that you should be thinking about, and you should go and research these to your level of comfortability. Yes.
There's a general rule of thumb of 1% on your capital basis on rent. Been around for a long time, high interest rate environment, 90s. So like $300,000 house should bring in $1,000 a month for it to make sense. So that might be a starting point. If you're seeing they're getting, this house is going to get $450 on the market, open market, and they're only going to get like $2,200 a month of rent. But otherwise, there's calculators if you want.
And I think just be careful about, those are conversations. It's not just about payment versus rental payment, right? It's also liability. It's also, what does this look like longer term for you? There's also damage, things that could happen to the property with a renter versus an owner. I mean, both ways there's liabilities. So just make sure that they're aware of as many of those things you can point out so that they can research them. Yes.
They're assuming the mortgage.
This is not an assumable mortgage. We're having a whole different conversation. We talked about assumable mortgages. We're done with that conversation. Now we are talking about contract for deeds, which is a completely different animal. So they are not assuming this mortgage. The seller is offering seller financing in a contract for deed. They are the bank. So if they also owe the bank
they need to make sure that the bank is okay with them also bringing somebody else in. Due on sale literally means that that mortgage is due at the time of sale. It needs to be paid off. So if that is in their mortgage, which it more than likely is, and they want to still pursue a contract for deed, I would get an attorney involved very quickly. Good. Do I want to offer a contract for deed? This is a question I would ask my sellers as well. Is this something you want to take on? Why is this buyer needing or wanting to do a contract for deed? Do they have horrible credit and they can't even get into a rental property? Or do they have a bunch of cash and great credit, but they're logistically bound up for 1 year because they're trying to move 2 people from different coasts to here, and it's a lot, right? That might make more sense than taking on additional liability. And again, it's not my judgment to make, it's the seller's judgment to make, but them being aware of what those terms are or what those reasons are very important for your seller to understand. Good? Yeah, Ryan's shaking his head, must be good. All right, so for buyers, things to consider. Does a contract for deed make sense for the buyer? So mostly these are going to be terms. What are the terms that the seller is going to be okay with? And do those make sense for you? So terms would be interest rate, length of contract. When is that balloon payment due? Is the seller okay with a 2-year, a 3-year, a 5-year, a 10-year? And is that going to fit with what you need to clear up to be able to put a mortgage on this property? Usually it's logistically, they have to clear something up. Credit-wise, they have to clear something up. Job history, like we talked about, there's a reason that they're looking for this middle ground of a contract for deed. So what is that? And are they going to be able to, is the length of contract make sense? If you can't qualify for a mortgage now, are you going to be able to in that 2 years or 3 years or 5 years? Really, as a buyer, getting serious. If it's credit problems, what are you going to do? And is it possible for you to get them in line so that you are able to get a mortgage? Because at the end of this contract, if you can't get a mortgage, that seller could boot you, keep your down payment, all the payments you've made, and you're out. You're done. Your period is up for you to fulfill that contract. And if you didn't fulfill it, bummer. So getting really serious with yourself of, if whatever it is that's making me look at doing a contract for deed, am I going to be able to clear that or get that figured out so that a mortgage becomes accessible for me? Make sense? Down payment, how much down am I going to be putting down? And does that make sense for me financially? Knowing that if something goes awry, that down payment is not coming back to me. The seller is going to keep it. Who's going to be paying taxes and insurance? How am I going to make sure, if it's the seller, that those taxes, insurance payments are being made? Comes back to trust, right? This is why it's usually done when people know each other. Who's making them, and how does either side make sure that the person is making them? Because as the owner of the home, the buyer, if all of a sudden you find out you don't have insurance and you're in tax default, how are we going to remedy that? And if you become at odds with the person, how is that going to be remedied? Okay, so understanding that that is a thing. Repairs, upkeep, expenses, can I afford all of that stuff? Is this really, that's all on the buyer, they own the property. Is that going to make sense for them financially? Do I understand interest rates and interest rate costs? Is there a prepayment option? So making sure that if I'm ready in 6 months instead of 2 years, can I fulfill this contract faster? Usually that's fine, but make sure that that is a term that everyone's aware of and everybody's agreed upon. Questions about that, about those terms? No? Right. We talked about this a little bit already for the buyers. What happens if I can't make payments or something goes goofy? I can't fulfill the contract at the end of that term. In all big letters, you will lose the house. That is just, it is what it is. If you are behind on payments,
There is a process that the seller goes through. Again, usually an attorney would get involved at that point. You will lose the house. You will lose your down payment. You will lose all the payments you have made, and you will not have a home. Yes.
I heard that the, ability to foreclose or, that is only like 60 days on a contract for deed as opposed to, I don't know, a year or something on a standard mortgage or whatever. I don't know. What is it?
Yes. Great transition, like I paid you for that. Cancellation for contract of deed, it's not called foreclosure, it's called a cancellation of the contract. And it can be canceled in 60 days. So 2 missed payments and they can start this process of canceling the contract. The seller has to provide and legally serve a notice of cancellation. That notice of cancellation lists out what the back amount owed and any fees that are legally able to be charged as well. Again, consult an attorney if this ever gets to this point, would be my suggestion for a seller or for you as an agent. They have to include that total amount. At that time, the buyer has the option to pay that. If they can pay that total amount before the cancellation notice is finalized, there's a date on it. If they can pay that, then they're back in good standing and the seller can't proceed with trying to kick them out. If they cannot pay that, then they're done. And then legally, again, I believe there are, and I think you might have shared, there's eviction law that comes into play. There's additional layers, but the actual cancellation of contract can be started after 60 days. And then there's laws, and we're not going to go into that too deeply, but there's additional things that you have to go through. Yeah.
Usury law and, percentage of, interest to be charged. You know, any just basics on that?
Absolutely not. and I'm not going to touch it. And on those things, I think they change also.
Right.
Yeah, I would definitely consult an attorney if you ever get to that point. So how do we do one? Again, I mentioned this right at the beginning. There is a contract for deed financing addendum that is in your normal contracts in transaction desk in the MLS. Those lay out all of the terms that you should be aware of. I think if you are even considering talking to anybody about contract for deeds, go read that form from start to finish about 16 times before you have the conversation. It will start to educate your brain on all the different terms that you should be aware of, what you should be making sure they're aware of and considering when choosing, should I move forward with this or should I even consider this as an option? If you're going to not use an attorney, and again, I would make sure that your people either know each other, are related, or are very confident and probably willing to sign something that says I was given the option to consult an attorney and I chose not to. That's actually part of the contract for deed form as well. If you are not using an attorney, however, you can fill out that form. It has to be completely filled out. That is, again, the title company can draw up the actual contract for deed, but that is what they are going to use to draw that up. So just make sure that that is complete, or you can contact an attorney and they will walk through all parties and make sure that they're having those conversations with everyone. Question from online?
Online, yeah, they're asking which form are you recommending that you read?
At least 16 times. It is the share. Addendum to purchase agreement, contract for deed financing, as shown here. So these would be all the terms. Before we had all the financing terms on the purchase agreement, this was like just another, there was the addendum to purchase agreement, FHA financing, conventional financing, right? They were all separate documents. This one just stayed separate because it's way too many terms to put into the purchase agreement, but it's also not as common. So they left this one over on the side. So it would be a box you would check on that list of addendums that you have added to the purchase agreement. It would also be checked under the financing of what kind of financing you're doing. And then this is what takes care of all of the terms of the contract between the buyer and the seller. We have 2 minutes for questions.
On the half a dozen or so that you've done, or the handful that you've done, how have they gone?
Beautifully.
Both buyers and sellers you've represented?
Yes, I have typically been where I'm just coming in to help them navigate all of the terms and then put the documents together to get to the decided company.
And in those transactions, have they been primarily family members that you've been working with?
My family members
No, family members.
of each other,
The two.
I would, either family or they knew each other very well in some capacity.
That's like 90% of the CDs, something.
Yeah, probably.
I mean, there's some sophisticated investors.
Yeah.
Yeah.
But mostly it's up north farmland, generational passing down
Cabins,
habits.
lake properties. I'm trying to think, the ones that I've done have been primarily, lake properties that were family passing, land. And a couple other goofy properties, but
The transactions that you've done, were there appraisals? Or not?
that is a great question. She asked, were there appraisals in the transaction as I've done? I don't think anyone did an appraisal, but again, they knew each other. I think that if there's an agent involved and you're showing market data, we can show appraisal data, right? Is it an actual appraisal? No, obviously, but what good is an appraisal today if you're gonna do a contract balloon 3 years from now? If you feel like it's market value and you're not overpaying. But I would be very cautious about that because you're gonna have to refinance or get a mortgage in a few years. And what happens if the market has shifted? How much down are you putting? Again, these are all those big pictures. If I'm only putting 5% down or a very small amount down, A, why would the seller do that? But B, if the market shifts in a negative fashion, am I gonna be able to bring the extra money to refinance out of this if it doesn't appraise? Because I guarantee the lender's gonna make it appraise, or they're gonna require an appraisal in 2 or 3 years. So we never know which direction the market's going. I mean, these are risks that everybody takes when you're purchasing anything, right? What happens if I have to sell in 3 years and I have to bring $30,000 to closing? The same thing could happen, but just make sure that people are aware of those risks and aware that that is part of the process.
Tish is necessary to start the process, whether you're doing contract or deed or otherwise, or
A truth in housing is required anytime a transfer of property is happening. So I would say, yes, a truth in housing would absolutely be required. Other questions? I will end this with quickly, one thing we did not touch on is interest rate / amortization. What does that look like? That is a term that is, again, negotiable. So if we're looking at a 5% interest rate today, I would make sure that you're looking up, or your clients are looking up an amortization chart that everybody signs off on and feels comfortable with. And that chart is what would be used for payoff at the time of balloon payment. That chart is what would be used to make sure that payments every month have been agreed upon, et cetera.
You put that into the transact, you put that into paperwork.
I've printed off a literal, like, if you're using a 30-year amortization chart, I've printed off the entire thing, even if it's only a 3-year balloon, and put that in and had everybody sign off on it, agreeing to it.
I'll just add on the, if you're going to refinance it, you're gonna have to be able to show 12 months of payments. Just FYI, so make sure you're not just paying cash. You've got a way to be able to track that, because obviously the person that is collecting those payments is not probably reporting that to the credit bureaus like a normal mortgage. Also make sure that it is recorded. So.
Yeah, I've had a lot of investors call on listings or call with buyers and kind of say, well, we don't have to record it. Well, yes, you do. It is not legal. It means absolutely nothing if you do not record that contract for deed. No one is protected if it isn't recorded. So it 100% has got to be recorded to be a legal transaction.
And it's the buyer's responsibility to record the contract for deed in Minnesota, FYI.
Yeah, if people online didn't hear that, it's the buyer's responsibility to make sure that that is recorded in the state of Minnesota. This is, again, an attorney and or title company is going to make sure that all of these things are taken care of. But make sure that everyone's aware of that. Yes.
How would you go about, reporting payments to a credit bureau, as a seller, I guess, right? How would you go about that? Is that a how's that?
So if I'm the seller and I'm recording it so that you can increase your credit score over time
Well,
as a
right,
buyer,
I
or
guess, yeah.
or have that, the how, I have no idea. Make sure that that's agreed upon as part of the transaction, because again, the seller does not have to do that. That is not that's not their job. So make sure that if it's important that a buyer has that recorded with the credit union, that somebody knows how to do it and somebody's making sure the seller is doing it and they are legally agreeing to do it. One thing I will note is that, and Claire, you could maybe speak to this a little bit more. A lot of our contracts they're not meant to hold people to things after the closing. Right? Mortgages are, contract for deeds technically are, because they are that middle ground. But most real estate contracts are not. It's not an ongoing agreement, right? Have anyone had the seller say, well, how do I make sure that these closing costs I'm giving them are actually gonna have that repair done? I'm like, well, you're not, because you don't own the property anymore, and that's not what our contracts do. They don't hold things to. So if you're adding things in like that, get an attorney involved, because that is a term of holding somebody to action after closing, and that always makes me nervous. It's not what our contracts are meant to do.
The lender's not gonna require that you do that, though. We just wanna make sure that we see bank statements for 12 months showing that the same payment was being made on, at least by the first of the month of each month. You're not like skipping months of payments and whatnot. So as long as it's being tracked.
Claire, any final thoughts?
You know, I hear all of the things that happen after closing, right? And usually it's not good. And at least, it's like, it's done, right? The buyer and the seller don't have a relationship. But in a contract for deed, a buyer and a seller are going to have a relationship until that loan is paid off. And it's a business relationship. And when the sewer backs up, or when the tree falls down, the buyer who owns the property is left. This is their problem. And they're gonna pick up the phone, they're gonna call you. So just be prepared. There's so much risk. There's so much risk.
How often do you see it?
For contract for deed?
Yeah.
Rare. I mean, in the last 6 months, I've seen like 3 come through the office. And they've all been on investors. Before that, I haven't. And I don't know that, I think that people who know what they're doing, fine, but even so, there can be disputes that arise afterwards, and you want to extricate yourself, you're done, it's closed, it's done. You're not doing anything on anybody's behalf. And I think that if it's a family relationship, or there's some sort of goodwill, trust, that's fine. I think in other ways, I think it can be a challenge. I don't think that for the normal seller, and for the normal buyer, it is the best option.
I will share anecdotally that a year ago, I was starting with contract for deed financing as a buyer because of logistical reasons. 2 properties to sell, just a kind of a messy trying to navigate getting people out of properties. One's my older mother, and started down the path, and it got messy so fast that I just said, I'm going to figure out moving money around, and I'll just put less down and I'll refi in a year or 2, because this is getting ugly before we're even. And this was a great seller. Agent owned the listing, probably the 2 very educated people trying to move forward. And we both just kind of put our hands up. We're like, hey, let's just transition this to 10% down conventional and have all of these questions answered by just having it be a straight transfer of property. So it can get messy very easily. Yeah. Any other onlines? All right. Well, we went 8 minutes over. We started 3 minutes late, so that's right par for the course for me. Thanks for coming, everybody.
Thank you.
Good.
Good. It's easy.
You were next coffee talk yesterday.
Thank you, you too.